Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of those big corporate filings so you don't have to let's dive into a massive report from a fund called New Perspective Fund and see if it is really offering a fresh outlook. Or just the same old story, this filing is a deep dive into the fund's performance for the year ending the 30th of September 25. And folks, there are a lot of numbers, but also some interesting things to uncover about how your money is potentially growing or not growing. Alright, first up we see that the class of shares of this New Perspective Fund saw a gain of 17.27% for the year. That sounds pretty good, right, matching the MSCI Acqui All Country World Index. But here is where it gets tricky. This number is calculated without considering any sales charges. So for the average investor who pays those fees, the actual return will be lower. For class of shares, that meant a 10.52% return over 1 year after the maximum sales charge was taken into account. That is a big difference. A lot of your return gets eaten up by those initial costs. And look at this. The cost for a hypothetical $10,000 investment in class of shares was $77 or 0.71%. That might not sound like a lot, but over years and across many investors, it adds up. For Class C shares, the cost was a hefty $159 or 1.47%. These fees are crucial to understand because they directly impact your final gains. Interestingly, the report highlights different share classes, each with its own set of fees and returns. For example, Class T shares without a sales charge gained 17.56%. That is even better than Class A. But the report also notes that Class T shares are no longer available for purchase. It seems the fund is phasing out some options. Now let's get into where the money is actually invested. As of the 30th of September 2025, the fund had a massive 96.52% invested in common stocks. This is a growth-focused fund, and that much in stock shows it. The top sectors driving performance were information technology at 22.41% and industrials at 14.56%. These are sectors known for innovation and global economic activity. The fund holds major players like Microsoft with over 11 million shares and Taiwan Semiconductor Manufacturing Company with over 131 million shares. These are huge holdings showing a focus on large established tech companies. However, there was a drag on performance as well. The healthcare sector at 11.38% of net assets was a significant detractor. Even though it is a large part of the portfolio, its returns were the lowest among all sectors, amplifying the negative impact. They also had notable holdings in companies like AstraZeneca and Eli Lilly and Company, but it seems the sector as a whole underperformed. Materials and real estate also delivered negative returns. The fund itself is enormous with $162 billion in net assets. This is a colossal amount of money, which means the fund's investment decisions have a real impact on the market. The total number of portfolio holdings was 287, a diversified approach. The portfolio turnover rate was 23%, meaning they bought and sold about a quarter of their holdings during the year. This usually suggests a fairly stable strategy rather than aggressive trading. Looking at the long-term average annual returns class of shares without a sales charge delivered 17.27% for the year and 11.99% over 5 years. Comparing this to the MSCI Acqui Index, which also saw 17.27% for the year and 13.54% over 5 years, shows that while the fund's raw performance is good, it sometimes trails the broader market, especially over longer periods when fees are considered. The difference between the with and without sales charge numbers for Class A is quite stark, indicating the impact of those upfront costs. Digging into the financial statements, it is clear this is a complex financial operation. The statement of assets and liabilities shows the fund's massive investment portfolio valued at over $162 billion. They also held over $9 million in cash and had significant receivables for investment sales and dividends. Liabilities include collateral for securities on loan, which is a standard practice for large funds generating a bit of extra income. The notes to the financial statements are where the real detail lies. They explain the different share classes, the fees associated with each, and how income and expenses are allocated. For instance, they detail how distribution services, transfer agent services, and administrative services are handled differently for each class, impacting your net return. The fund's investment advisor, Capital Research and Management Company, or CRMC, manages all these complexities. The independent auditor Deloitte Hambite Touch LLP gave a clean opinion stating that the financial statements and financial highlights present fairly. This is a crucial sign of financial integrity. They've been auditing these American funds since 1956, which suggests a long-standing relationship and expertise. A significant part of this report discusses the board's approval of the investment advisory and service agreement with CRMC. This is essentially the contract that allows CRMC to manage the fund's money. The board reviewed CRMC services, investment results, fees, and profitability. They concluded that CRMC's management has been satisfactory and that the fees charged are fair given the quality of services and investment performance over the long term. This is a standard but important part of corporate governance, ensuring the ongoing relationship with the manager is beneficial for shareholders. So, what is the story here? New Perspective Fund is a giant in the investment world managing billions of dollars. It delivered strong raw performance this past year, particularly in tech and industrials. However, the devil is in the details of those fees and different share classes. For investors paying sales charges, the actual returns are significantly lower than the headline numbers. The fund size means it can hold substantial stakes in major companies, and its long-term investment strategy seems to be approved by the board. Risks remain as always, with market volatility and sector-specific downturns like healthcare impacting overall results. For investors looking at this fund, it is vital to understand the nuances of the share class you are considering. The difference between a Class A share with its sales charges and a Class F share with lower fees can be substantial over time. The fund offers diversification and exposure to global markets, but you need to be aware of the costs associated with accessing those returns. It is about finding the right balance between potential growth and the fees you pay to get there. Alright, that is my breakdown of the New Perspective Fund filing. What is your take on these numbers and what they signal for the company's future? Did you find the fee structures confusing, or are you impressed by the sheer scale of this fund? Let me know your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate finance. Don't forget to check out the Discord community linked in the description below for more discussions. Thanks for watching, see you next time.